Hi, it's James Black here from the Canadian Securities Exchange, and today I'm joined by my good friend Chris at OTC Markets. And today, the benefits for CSE listed companies to quote on the OTC markets, whether it's on the OTC QX, OTC QB. Chris is going to go through some of the different reasons why you should really consider this option for your company.
Thanks for having me, James. So you'll know this, but for those that don't, we have worked alongside the CSE for many years, and you have hundreds of your listed clients already cross-trading onto our QB and QX markets, which are our premium markets, which elicit the highest trading volumes.
Thanks for that, Chris. Maybe just provide us a brief overview of the OTC markets and what you guys do.
In simple form, OTC Markets Group is the largest ATS, or alternative trading system in the States, meaning that if you set up properly and you put the right settlement mechanisms and quotation requirements in place, you join the QB, QX markets, you have unfettered access to allow the broader US retail, institutional, family office, wrapped accounts, or managed accounts, I should say, to be able to hold the company's stock. So you've got to go out there and do the work and sell the story. But the reality is that companies that are listed outside the US don't passport naturally into the States. And so we provide the trading platform and the compliance solutions to allow all that to happen.
And more succinctly, Chris, can you describe some of the specific advantages for CSE listed companies to quote on one of your marketplaces?
Yeah, so look, this isn't a CSE specific problem. As I alluded to, if you are listed outside of the US, you can be as shareholder friendly and regulated and transparent as possible. But the US is unique, just like many other countries, but even more so complex in that every state has a set of securities laws designed to protect the residents of that state. And so that means that you as a company your stock can't be solicited, no one can recommend you, advisors can't buy your stock to go into a portfolio on behalf of high net worth retail. And so that's just one example of the restrictions in place for companies listed outside the States who hope to grow their US ownership. So we built the QB, the venture market, and the OTC QX, the best market, as markets which allow you to come into the US, to have your information and your news, your financials distributed to all of the broker dealers, to all of the areas in which people do their research, to allow all brokers to be able to quote you in US dollars, and ultimately with increased volume and interest and visibility, and importantly added compliance, that flow tends to go back to the home market because most of the brokers in the States aren't holding these foreign company stocks.
In general terms, what percentage increase in trading volume can an issuer expect if they are to go and quote on the OTC markets?
When they join OTC QB, they typically see their global volume of trading increase by about 72%. Now, when companies then mature and get to the stage that they qualify for the OTC QX, the highest tier of the market, there's normally, yes, they have a larger US ownership at that point, about a 28% increase to global volume again. So they're just a small number of the benefits.
A company that is about to be listed on the CSE, what are the steps they should take to be prepared to be quoted on either the OTC QX or the OTC QB?
Well, I'll give you guys props because I know that you go the extra effort of educating companies and hand-holding and making the introduction. So we always appreciate that. I think if it's in preparation for a CSE listing, at that point, a conversation with OTC Markets Group is good use of time because it allows you to better understand what the application process would look like if you wanted to set up here. A lot of time, your clients will tell us that they want to set up immediately. And so not just having the budget allocated and the paperwork ready, but also submitting the information or the application at the right time. All of that is helpful. But the reality is that the process is a 6 to 10 week process where the company would send in their information. We can start processing it. We do rely entirely on this SEC exemption for reporting called 12G32B. And so being listed on the CSE allows companies to join our markets without taking on additional regulatory burden, no SEC filing, no Sarbanes-Oxley, no increased risk. It's quite an efficient and quick tool to put in place.
Now, if a company's already up and running on the CSE and they've been trading for a little bit, Anything different that they have to do to be quoted on the OTCQX or QB? Anything that they can do or prepare for that makes this seamless?
I think if you had have asked that question 10 or 15 years ago, the reality was that just having a US ticker was good enough. And broker-dealers, prior to the SEC changing Rule 15C to 11, which is all about quote eligibility and tradability in the States, prior to that, most companies did find that they would have a broker set up a symbol. But, and I can't emphasize this enough, we're now in a place where we're a regulated market. QX and QB markets meet the rules required for continued quote eligibility. They provide the blue sky exemption. So the reason why I stress that part is the short answer is we'd love to speak with those companies and just make sure that they understand what they have versus the benefits of QBQX. I would be willing to bet many companies on your market, they know they've got a pink ticker, but they don't necessarily understand that it's like having a car without wheels on it on the driveway. You've got to put all of the compliance and trading function in, which comes with the QBQX markets.
Chris, for companies that are on the pink sheets, what are your advice to them? Should they be considering a move to the QX or the QB if they're eligible?
Of course, it entirely depends on the company's aspirations. I think it's fair. Most people would agree that, you know, you look south of the border from Canada and it seemed to be the largest and deepest pool of retail investors, right? I guess that's what we're talking about within a certain market cap. Until you get to the stage that you're an institutional play, you should be maximizing your exposure to the broadest pool of retail investors. And so the short answer is yes, of course, it would be nice to think that all of your clients would join our market. But the reality is that some do not aspire to grow their US ownership. We fix many pain points. So for example, most companies that join us either are undervalued or they're illiquid, or that they just see that it makes a lot of sense to be in the States. If you've already gone through the cost of going public, why not just switch on the lights and have a good way to draw more investor interest? So yeah, I think it comes down to a strategic decision.
Chris, just tell me a bit about the cost structure and what companies should expect to pay being quoted on one of your markets.
For QB, $15,000 a year, and the QX market is $25,000. So in the greater scheme of being public and how much you actually spend, I think our client base speaks for itself.
Chris, just to be clear, these markets that you operate aren't just for small to micro cap companies. Maybe name some of the bigger clients that you guys host on your marketplaces.
But I should have mentioned, you know, even some of the largest multinational corporate names like Adidas, Heineken, Roche is our largest client at 250 billion plus market cap, CSL, you know, all of these companies, they elect QX as their US trading venue of choice. And so it just goes to show you don't need a US exchange. You don't need to spend millions of dollars on this stuff, but this is opportunity available to the small and the micro cap too.
Well, thanks for that, Chris. Is there ever a time a company should consider a national listing in the US? So I'm talking about the NYSE and the NASDAQ as a listing destination for a company that's already trading in Canada.
Yes, absolutely. It does make sense for some. And I think this is probably more of the interesting conversation or debate around why and when. You know, there are instances where it makes sense. So one of those instances would be if, as a company, whether it's through organic growth or through acquisition, that company has become really more of a US company. So it's not just shareholders, but servicing employees as well, right? I think that's an instance where at some point it makes sense to entertain a US exchange listing. Another scenario would be if the company is listed outside of the US and the company needs a significant financing. And so what we're saying here is your traditional sort of public offering, and they're unable to do that in their home market, wherever that might be. At that stage, if it's a play that tends to resonate better with US investors and it is a significant sum, that would be a very good reason to entertain a dual listing in the US on an exchange. I think it really just comes down to, it has to be a cost-benefit analysis, and the company really needs to think very carefully about whether they are large enough and whether the listing is sustainable, right? It's not just the initial requirements, but it's the ongoing requirements and the significant spend, right? I talk to companies on a regular basis who have gone through this process and are struggling to retain the listing simply because they did a reverse split just to be able to qualify. They perhaps didn't raise the money that they needed to. And now as management, they're out of compliance and they're spending far more time trying to retain the listing than they are running and growing the business, which is how the value is built for shareholders. So there's definitely a time and a place.
Chris, it sounds like this is an opportunity for the right company, but tell me, what are the risks for a company that does this too soon or isn't prepared to go list on a national exchange?
Yeah, it's a tough question, especially when you spend any amount of time going to conferences and you've got the panel with the US exchanges and a law firm and the investment banks, and it's made to sound like it's easy to list in the US. The reality is, if you look at just the facts, if you aren't going to be eligible for the Russell 3000, a microcap company is going to find it incredibly challenging and, in the end, question why they did this. I know that a lot of companies out of Canada naturally see a US exchange listing as a success, and it's celebrated, of course. But the important thing is, look at the facts and what happened after the event. There are currently more than 500 companies on the US exchanges that are out of compliance. We recently, or last year, we looked at all of the deals, all of the listings, the new listings that occurred on US exchanges in the sub 300 million US market cap. And it reads for absolutely dreadful results. And the reason why that is that, unfortunately, and we call it lawful but awful, there are a group of conflicted bankers and advisors out there who make an awful lot of money monetizing taking companies public. And, D&O insurance is just one example of why it's expensive, right? That can easily be a seven-figure sum. For a small cap company, that's ridiculous. But it is the nature of the rule set around the US markets. But if you look at the 91 deals in that sub 300 million market cap, 92% of them are underwater. The average is minus 65% return. So the markets, that's not a reflection of the markets. It's a reflection of bad advice, companies being encouraged to go public in the US too soon, often either not raising sufficient money, or worse, the bankers attach warrants to the stock, right? The bankers are already being paid on the deal. So to take commission and additional payment for what eventually ends up just being a spiral of, investors are savvy. Investors see a reverse split to qualify for NASDAQ or NYSE. Now you're just manipulating the company to qualify. So just because you can doesn't mean you should. And unfortunately, that downward spiral leads to, often, in many cases, it's another reverse split. Then the warrants kick in, and then the short sellers come in. And, this is something that we need to just talk about more. 34% of the companies went out of compliance, right? So we're talking within a year of listing, they celebrated and rang the bell, did the market open, they're out of compliance. More than half of these companies either did a reverse split before the list or post to try and get back into compliance. And just 5 banks in the US were responsible for more than half the deals. And 5 law firms were responsible for a quarter of those deals. So all I'm saying here is, don't think that listing in the US is bad. You just really have to think very carefully and be measured. And that's why I think there's so many more Canadian issuers on our QB and QX markets, because a lot of those CEOs and CFOs are quite savvy, and they understand that when a banker tells them that they need to list in the US to have trading, they know it's false because they see the volume on our markets.
Chris, much like we've experienced here at the CSE, just getting quoted or trading isn't necessarily the end of the road. It's just the start of a new journey. So maybe explain to those who are considering an OTC quotation or upgrading from the pink sheets to OTC QX or OTC QB, what work is involved after they do that that's going to help them maximize the value of their investment in that process.
I think the way to think of this is, well, first off, shares are sold, they're not bought, right? And so investor relations, obviously it's a marketing initiative. It would be disingenuous of us as a market to take the fee to join and just hope that companies are successful. I mean, they need to have news flow. And so these are the kind of conversations that we have up front with issuers who are considering joining is, this isn't just about setting up correctly in the US on the QB and the QX markets, but it is ensuring that they have an appreciation for whatever marketing you do in your home country, and whether it's Canada or any other country in the world, you have to go out and tell your story. And so, yes, open the door to a much broader audience. But, just being on our markets gets you access to a variety of free investor engagement tools. So companies are posting their news and financials. They're posting videos and any other sort of research reports. That gets redistributed. So that's efficient and a requirement. We operate the Virtual Investor Conference platform, and so we host more than 30 conferences throughout the year. Some of them are in person in our New York office, but many of them are either hybrid or entirely virtual. And especially small and micro-cap companies that have limited travel and budget for these things. These are nice bolt-ons where they get the contact names of investors who have expressed interest. Maybe they do Q&A. But yeah, the general conversation is, look, there are a lot of good conferences. We can talk about the good and the bad and what to look out for.
And with that, I want to thank you, Chris, for an insightful and detailed discussion about the many benefits of the OTC Market Group's OTC QX and OTC QB marketplaces. For those watching who want to know more about OTC Markets, simply go to their website, otcmarkets.com. I'm James Black with the Canadian Securities Exchange. I encourage you to follow us on social and contact me directly to let me know what kind of content and guests you would like to see on the show going forward. We'd like to focus this content for companies that are listed on the CSE, but really anyone who follows the public markets. So we're open. Follow us on social, and we'll talk to you very soon. All the best.